This specialization is designed for three types of people. The first set of people who are thinking about pursuing a degree in either business, finance, or an applied discipline. It'll be extremely useful in terms of giving you exposure of what may come down the road. The second audience is people who are at work, want to learn finance to do better at their job. And the third audience is actually not a distinct audience, but an audience that belongs to the first two. It'll help you understand how to make personal decisions in life, which we always have to do, regardless of age these days. I hope you take this specialization, and I hope you learn a ton from it. See you. So if you stare at the screen now, what I've done for you is I've listed all the principles again. And I know sometimes I go slow, sometimes I go fast, but it's by design. When things are really important, I want you to understand them. And this is something that applies to every project, every idea. Money, no money, this is how you should think. Okay, you should think about life, love, whatever in this way. And it'll kind of uplift you. Think about the future, think about it clearly, yet use your heart too while making decisions, right? Finance allows you to use your head and your heart. Okay, let's move on to something that's new stuff. So before I go there, let me just revisit one idea. That is the length of the timeline, and that's another thing that I keep talking about, the timeline. But here, just a little pause. Remember I told you that the beginning of a project is an important point. But the end of the project is also an important point, and I deliberately stayed away from talking about it for a little while. And the reason is we are going to move on to the notion of bonds and stocks today. And the reason I'm going to bonds and stocks, remember, is financing. And the reason we are going to financing is because we want to figure out for this purpose, for our class, our course, we want to figure out what the cost of capital is and how do you get it. And that's what it's all about. Of course, you want to understand financing from a personal standpoint. And the nice thing about whatever we do next is bonds, stocks, risk, it's personal. In other words, you can think like an investor or a person who's going to invest later. So except for cash flow estimation for a project, which you may or may not do till you work or have an idea or whatever, you can use everything else for personal decision making and thinking. And remember, even if you don't have money, this is so cool. Okay? So let me show you what the end of the project looks like. Remember, our project was 10 years long. At the beginning, you should think of things which I said had capital in them, and they are negative usually, right? You have to spend stocks of things to start some flow. Okay, what happens here? If the project is over, you just close shop, you sell, inventory, etc. Basically, working capital comes back. And the notion is you're not going to use this working capital anymore. You also sell machines. So whatever capital happened in the beginning, you kind of undo it. It's not the same value, obviously, especially the machine. So you just undo it. And at that point, you have to take care of taxes and stuff like that. Just briefly, if a machine has been depreciated fully, and you sell it for $10, you have to pay taxes on that. On the other hand, if you haven't depreciated it fully, accounting wise, and $10 is the value of the machine and you haven't depreciated 5, you're allowed to depreciate 5 and pay taxes only on 5. Things like that you learn as you go along. What's important today is, suppose this is not true. Suppose you think the project will go on. And that's the difference between a project and a firm. A firm does go on, projects may or may not go on. So projects have finite lives, firms do not have finite lives. when you're thinking about them in the future, right? You don't start a new idea and say, it's going to be there only for 2 years. It's not a very good new idea, and it's not an empowering way to start something. Because if you are not that excited about its longevity, nobody else is going to be, right? So what do you do here? Remember, the last cash flow here is C10. We did an example where this was 1.9 million, and this could be, hopefully, say 20 million. That's the last period's cash flow. And what is cash flow? Net of all the expenses. Okay? So now what do you do? Suppose you expect it to go on. You figure out how long it's going to go on, take all its present value here, all the years here, future, and put it here. And you use simplistic formulas to do that. And the reason is very simple. All the value beyond year 11 to whatever, you cannot estimate precisely. In fact, I would encourage you to only do precise estimation for things that we know a lot about, right? I spoke about that. Your horizon should be dependent on how much you know, rather than, or the world knows, rather than something fixed, right? So year 11 and onwards can be thought of the following way. It's called terminal value. And we'll be using these formulas a lot today. That's why I'm introducing it. Terminal value can be thought of C11 over R minus G. Remember, I told you a formula of something that lasts forever is C over R minus G. I'm going to use it a lot today. And this is called a perpetuity. This guy is called a perpetuity. What is G? G is the growth rate. And you'll apply it to how much? 20 million. So what will C11 be? 20 times 1 plus G. How will you get G? G will be your estimation of how much growth you'll have after year 10. And what is R? R is, sorry for writing it in caps, it's our same old little r. So I just wanted to lay it all out here, is that you have two choices in a project. A project could end and you could sell the inventory, you could do all that and you could stop. Or you could think of a project like a firm which goes on forever. You can't do both. You can't stop and get value beyond year 10. We'll come back to this, and the reason I'm highlighting this is we are moving on to think about ongoing things. And ongoing things are called firms. And that's what we invest in. That's whose bonds and stocks we buy. And I think it was an important kind of midpoint to give you a sense of where we're going. What I'm going to do is I'm going to now introduce a couple of new things, and then we'll take another break. But just hang on with this. And the main topic for today and next week is going to be bonds and stocks. And the reason I gave you this idea of project versus firm is I think it's a good way to bring project analysis to the firm level and make you think about a firm. And bonds and stocks are typically issued by entities, okay? So let's get started with bonds and stocks. And today we'll spend a lot of time on bonds and try to do as much as possible. The reason I do not want to spend hours on bonds is one thing is very simple. I could teach a whole class on bonds. And the reason is bonds are typically peculiar to the US, especially in the private sector. Most bonds are loans. All bonds are eventually loans. And in most countries, loans are between you and the bank. Whereas bonds are things that are issued by entities when they borrow money. The one thing that the world does, and the US does too, is the governments issue bonds, and bonds are like IOUs. So we'll start with bonds, then talk about stocks next week. But this is where I have done most of my work. So I can get very excited, and that's the second reason I want to kind of keep it under control, is because this class is about value creation, and value creation happens through projects. The reason why we are doing bonds and stocks, as you'll see in a second, is to try to get at what is my cost of capital, what is my little r, okay? So if you understand that, please start off with why we are going on financing. So the first thing you have to always keep in mind is value is created by ideas, projects, entities, you. It's the gray matter here that creates value. Financing cannot per se be value creating. And the reason is very simple. If financing was value creating in a fundamental way, I would just call you up, sell your stock, you'd sell it back, we'd make money, share it, and move on. It cannot be possible for financing per se to create value. There are situations in which financing can create value, but those tend to be man-woman made situations, artificial, or some frictions that create value. Okay? How do you raise money to finance the idea? So now, though financing is not value creating per se by itself, if you didn't have financing, you wouldn't be able to implement the idea. Remember, I talked to you at the beginning of this class that the one fundamental principle we are going to have is democracy. And the way it's going to be reflected is through capital markets, flow of money. The only thing that I have been disappointed personally over the years is how little impact it has had on the world, not how much impact. By that I mean the following: markets are created for people, not the other way around. And if markets cannot serve democracy and do something to uplift poverty, then there's a problem. Of course, it's done a ton, but it could do much better, right? You always want to do better. Anyway, so the question here is, without markets, you can't get money. So the question is, how do you raise money? We could spend hours, in fact, months, weeks, years, whatever, on this topic, as I said. But I'm going to fundamentally talk about two kinds of financing. One is bonds, one is stocks. So why am I only restricting myself to this? For two reasons. One, as I said, the focus of this class is on value creation. The second is, if you understand these two, you understand any other kind of financing because it's a mix of the two. Snapshot of identity is extremely important, and after that I will take a break, and you should take a break too, because I think it's good to think about what we have been talking about. Real assets are on your left side. So we are not in this class talking about banks, because banks have financial assets and financial liabilities. We are talking about banks facilitating the creation of value. They do create value, but they are not the main engine drivers of new ideas and so on. Those come from creativity that requires financing. So the real assets are sitting, if you notice, on your asset side. One more time, they create cash flows and they require R. The primary reason I'm going to go to financing for this class is that I need to measure this. Rate of cost of capital. Remember, this is called cost of capital. And you'll see later the advantages of having a market. To figure out your cost of capital, doesn't belong to you, remember? It belongs to the next best competitor. The good news is, if you have publicly traded information about equity and debt, you can do cost of capital. You can figure out and try to mimic the beauty of law and law of one price. You can value things because you know what your comparables are doing. Okay, so but please remember the identity. Value on asset side, financing, a way of figuring out cost of capital, and then financing has a lot of value on its own to learn about. I've done a lot of research in it, but I'm trying to keep you very focused. So let's take a break now. I've given you a sense of where I'm going and why I'm going, and next time when we come back after a break, however long for you, let's get into talking about debt. And by the way, debt and bonds are the same thing. Equity and shares are the same thing. This is also called stock. Okay? See you in a little. Bye. Welcome back. As I said, I've set up your thinking, hopefully, for the next phase. We are going to talk about bonds and stocks. Bonds this week, stocks next week. They are very important to integrating our knowledge. And let's just see what a bond is. The good news with bonds is you already know what they are. Okay, but let's go slowly. Like the word suggests, bonds bind people. So the bond is like a contract between two people, one giving money, one getting money. We have seen these before. In fact, the most generic notion of a bond is a loan. And I want to make one thing very clear. A loan can be made or is made usually between one institution, a bank, and a person. So you take a mortgage loan. We did a loan for cars. We did a loan going to business school. You do a small loan to run your business. All of these are typically contracts, entity, that is whoever you are, and another entity, usually a bank. So I want you to understand that that's also a bond. The bonds we'll talk about today are a little bit more, and those are contracts that can then be traded on their own. And I think that's awesome in some sense, right? Because I have money to borrow. I don't have to just have the possibility of just going to the bank. Why shouldn't I be able to borrow from the public at large and then it be traded later? There are advantages to doing that. There are advantages to working with a bank too. So I'm not trying to say one is clearly dominant over the other. There's a lot of research on both. All I'm saying is, why not have both? Having said that, remember, this explicit IOU that's common to an entity versus an entity and common to what a bond is that we'll talk about, which is issued by one entity to everybody who wants to lend money, is an explicit IOU. Both are explicit IOUs, but one is an IOU that's between two specific entities, and one is an IOU between an entity and a population in general. Okay, so I will start off with the kind of entity that we all know about. And the reason is, unlike the peculiarities of corporate bonds, which I'll spend very little time on right at the end, government bonds are issued by everybody, every country. So when you have to borrow money, you being the government, you issue an IOU, and it's called a bond, right? And usually in America, it's called a government treasury bond. In your country, wherever you are, it'll have a name which will be very explicitly associated with the government. And by the way, it's not just the federal or the major central government that issues bonds. In the US, for example, municipals, state governments, state entities also issue bonds. Okay? And there are tax laws that are different across different bonds. What I'm going to do is I'm going to stay away from the tax laws because you can Google stuff like that. So whenever you can Google something, it's probably not reached that stage where thinking is deeply involved, right? As I said, though, once in a while I Google like, who am I? And Google kind of stares at me and says, if you haven't figured it out, how do you expect me to? But one day I think Google will know the answer to that. So let's keep moving. We're talking about government bonds. And my favorite bond is a zero coupon bond, which we'll keep coming back to. And what does coupon mean? Remember that coupon is something that's paid periodically, and we'll do that in a second. Whereas a bond pays coupon periodically. Remember the PMT? That's like a coupon. But a bond typically issued by the government and corporations pays in two ways. One is a coupon, like a PMT, and the other is face value, a fixed amount at maturity. And luckily, it's a round number. It's not like 22.232 makes you miserable thinking about decimals anyways, right? So the bond that I'm talking about right now pays only once and at maturity. Maturity is when the bond contract is over. Okay? So we'll see in a second, timelines will come in again. An example of such a bond is the Treasury bill or strip in the United States. What I'm going to do today too is, given that we are going to talk about publicly traded stocks and bonds today and next week, we will talk about what is happening in the market. I'll go on a website and show it to you, and then you can be on your own and kind of search around. I think it's pretty cool. Okay? So discount bonds are zero coupon bonds. Why are they discount? So let me ask you this before we do this little formula. So this is what the timeline looks like. 0 and some period n. Right? What does this bond do? So 1 year passes, 2 year passes, 3 year passes, 4 year passes. And it doesn't have to be years, it can be periods. Turns out actually in the US, the period is 6 months. That's how bonds are priced, on a 6-month periodic basis, because that's when coupons are paid with. What does this bond do? Doesn't do anything here. 0, 0, 0, 0, and then gives face value f. So that's the timeline. And the nature of this beast is very simple, right? So you start off with things that are very straightforward. So what is this? This says, give me some money today, which has not been indicated. Give me some P today for a future value in the future, obviously. Remember, this is which class? The very first class, where we talked about single payments. So it's something very simple for you to understand. What is the face value? Typically, it's a round number, and in our examples, just for simplicity, we'll use 1,000. It could be 100,000. It's not going to be a strange number, okay? And so what is the question going to be? I have to give you this and n, and it should be a very simple problem to solve. Everybody okay with this? So I want to be very clear on a zero coupon bond. So no coupons. It is also called discount. Why is that? For a very simple reason. R is greater than 0. If R is greater than 0, the price of a bond, has to be less than face value of this kind of bond. Why? Because there's no coupons to compensate for the decrease in value of F when you discount it back. So please don't think it's on sale. Don't think you're somehow making money. No. It's just compensating you for the time value of money, right? And in a fair way. So the reason why it's also called a discount bond, when you hear that word, as soon as you hear unqualified discount bond, you should be able to think zero coupon. Okay? So let's do examples. First, a very simple example. Suppose a zero coupon bond pays $1,000 exactly 1 year from now. What is the price of the bond today if the interest rate on similar bonds is 2%? And whenever I say interest rate unqualified, what does it mean? Monthly, quarterly, yearly? Always annual. So I'm going to give you a very simple example and then do another one, and then we'll take a break. Okay? This is very simple, right? I shouldn't have to do this on a calculator. I mean, with you, that is. You have to obviously use a calculator because you're dividing. So face value is 1,000. What is n? 1. So what do? You take 1,000 and divide by 1.02 raised to power 1. I'm just being a little painful here. Okay, so the answer is 980. How do you make sure your answer is right? Remember the beauty of finance? Make sure your answer is right. Take 980.39, multiply by 1.02. What should you get? You should get exactly $1,000. And if I made a mistake, fix it. Right? Making mistakes is okay in life. In fact, I promise you one thing. During these classes, I have made mistakes. Hopefully they are small ones like typing in the wrong number and so on. I'm trying to focus on the fundamentals being right and not so much on calculations. This is too simple, right? Okay, let's do a more complicated problem. And by the way, as I said, I'll show you real data today. So another concept which I'll now give you related to bonds is something called yield to maturity. Pretty simple to explain, right? What does yield mean? It's another word for kind of a return. To maturity means what? Till maturity, and the maturity is the length of the bond. Remember, bond is a contract. It has to specify the length of time, and it has to specify the amount of money at various stages before you're willing to enter that contract. Is that, yeah? So what is this bond? Remember, we are still in zero coupon bond world. What is the yield to maturity of a 10-year zero coupon bond with a face value of 1,000 and the current market price of 744.09? You can literally open up the newspaper and look for this bond and you'll find it. Okay, the face value may not be 1,000, it may be 100, but that's just a 0, right? Or a 10, depending on how you look at it. Okay, so look at the formula. So what have I done? I have replaced the R, the little r, by yield to maturity. And I'm asking the following question. If I take $1,000, how many periods from now? 10 periods from now. And I'm here, and I tell you this price. And I have 1 through 10 periods. I'm asking you, what is the rate of return built into this relationship? So you know the price has to be face value over 1 plus yield to maturity raised to power n. What is the number I don't know? This. Because I've told you this and I've told you this. And how have I told you this? That IOU that you get from the government tells you this. It says the face value is 1,000 and the coupon rate is 0. C over F. The coupon is a fraction of but it's not paying any. So notice what's going on. What's the problem here? If this was a 1 period problem, you could do it in your head. So what does the yield to maturity remind you of? You know, in finance what we do, like in a lot of stuff in life, we create new terminology so that you get confused. What is the yield to maturity in this context? Does it remind you of something? Yep, it should. It's the IRR of the bond. So if you solve for IRR, what do you get? You just have to worry about the fact that 10 years have passed. So remember, you have to do some little bit of math, and that's about it. Please do it, and the answer is 3%. I'll go and show you a simple way of doing this stuff on a calculator. You just have to hang on for a second. But let me just move on, because this is not going to be a difficult thing. It's just a calculation thing. But let me ask you this. Supposing you wanted to confirm whether the 3% was right. What would you do? You would take $1,000 and do its PV at what rate? 3%. And how many periods left? 10. And what answer should you get? PV of 1,000, 3% is the rate of return built into the bond. If you hold it till maturity, the price has to be this. If it's not, there's something wrong, and you can trade on it. And trading happens when the pricing doesn't seem right. All right? So even if it's off by 1 cent, these bonds trade more than anything else. And simply because they are viewed, as we'll see in a second, as risk-free. Okay? And we'll see why. But right now, let's stay on the mechanics. Is this clear? Yep? Okay. Let's do one more twist of it, and then I think it may be a good idea to just think about what we've been talking about. What comes first, price or yield to maturity? If you go back to the problem, I gave you price and you figured out yield to maturity. What comes first? Many people think both happen simultaneously, and I agree. Because if you know the price, you know the yield to maturity. If you know the yield to maturity, you know the price, right? One and the same thing. But I like to think you know the price before yield to maturity. People don't go around walking around saying, thinking in terms of percentages. No, the government comes and does literally this. I'm going to give you $1,000 10 years from now, right? It's in an auction, actually. How much will you pay me today? So you got to figure out value in your head. You carry value in your head, not percentages, right? So in some senses, the fact that I'm saying yield to maturity and price are determined together, I still believe that we think of price value first, right? It's like an auction. You want to buy an apple? How much will you pay for it? Similarly, do you want to buy $1,000 10 years from now? How much will you pay for it? And built into that exercise for that is a yield to maturity. What makes the yield to maturity of a zero coupon bond risk-free? This will keep coming. And the reason is if you start now, buy it for 744.09 and hold it till this time. Hold it for the entire time. What are you sure to get? You're sure to get the $1,000. So remember, if you hold it, that's why it's called yield to maturity. If you hold it till maturity, remember there's nothing happening in between. You're just holding it. You will get 1,000. Of course, what's the assumption there? The government is still there. And these days, that has become questionable too. So remember, value in finance is not by what you state you're going to do. It's what people perceive what's going to happen. So the same government which was sure to pay 10 years from now, we are struggling. Many times I think, would you rather buy a bond issued by Google or by the US government? I'm not sure which is risk-free, but that's just a thought. Don't believe just because the government is issuing it, it's risk-free. But we'll take that as a basic thinking right now, that it's the government will go after other things go, if it does, that is. So let's do one more twist on that problem we just did, and let's just real-world twist. Turns out, for government bonds, in the US at least, the compounding interval is 6 months. And if that's the case, what's the yield to maturity if the price is the same? So suppose I fix the price at 744.09. What is the yield to maturity on a 10-year bond? Turns out, what will it do? And we'll take a break after this. What do? You remember this, right? If every 6 months you're doing, the best thing to do is what? Change your timeline. So make this 120. Well, how much are you getting at the end? Still 1,000. Just for the sake of argument, I'm just fixing this price at 744. Just to make you think a little bit. Quick question. What would you say about the yield to maturity compared to the last one? What was the last one? 3%. That's why I fixed the price. Face value is fixed too. You would want to say half of it, right? You would want to say 1.5%. And that's where you might as well take a dagger and shove it right in my gut. Because what are you ignoring? Always pause. You're ignoring compounding. So the number has to be less than 1.5, right? So please do this exercise. Make sure I got the number right. What will you do? You'll do the PV of $1,000. How much N? 20. And what is the interest rate? 1.489. And what should you get? Good old 744.09. Let's take a break. Think about this. It's the simplest bond. See you soon. Welcome back. So we did some simple examples of the simplest security or bond there is out there, which is a government bond which pays no coupon. And we try to calculate the yield to maturity. Let me tell you a little simple way of doing this. And let's take $1,000 and divide by 744.09. What is this telling me? This is telling me future value, 1,000, and present value, right? The only two things I know. However, the key here is the number of periods that pass, right? So let me return it. So that is 1.3439. Now let me do this. Take A1 and I take the 10th root of this. Remember, we are doing compounding. So if it's over 10 years without compounding, I do the 10th root of it. It's raised to power 0.1. 1.03. So you remember the 3%? You subtract 1 out of this calculation and you get the yield to maturity, right? Because it's future value over present value. And you have to subtract the 1 because that's the $1 you put in is your investment, right? The rate of return is not bad. Now, what's the difference between this and if I make compounding happen every 6 months? I'm taking now 1 to the 20th. So take A1 and now 1 to the 20th is what? 0.05. Okay, there. I can see what I did. My nervous hand put 2 equals. You see, I make very silly mistakes. So 1.01489. So you see how I did it. I'm just showing you that the fact of compounding is the only reason that calculations become a little bit tricky and difficult. Okay, so let's move on. And I got 1.489. I would encourage you to be very familiar with this stuff. So something that you'll see all the time in the press, and towards the end we'll go to a website and see all of this, is something called the yield curve. And it's in your face every morning. If you pick up any newspaper to do with money or reporting about the economy, you'll see this. And I wanted you to get a flavor of what that means. It is the relationship between the maturity of a bond and the yield, and it's for government bonds. And purely should be zero coupon bonds because it's trying to show you the connection between the length of time and the interest rate on government bonds. So if you throw in coupons, it's not really picking up the relationship cleanly. Typical relationship and why. Let me just show you the typical relationship and why. So drawing a graph, if this is 0, right, and this is yield, and suppose this is 1 year, this is 2 years, this is 30 years. And the reason I'm doing 30 is, believe it or not, you can buy a bond that promises to pay you $100 30 years from now, and it is traded, and it has a price, you know. So that's why I kind of find it really cool. So the typical relationship is something like this. It tends to go up. And I want to make sure that you get it before we do coupon bonds. So the typical relationship is going up. Why is that? The reason is very straightforward. If you buy a 1-year bond versus a 2-year bond, or compare a 1-year bond with a 10-year bond, whose price is likely to be varying a lot? Always keep risk at the back of your mind. But now I'm increasingly going to pull that concept out and bring it to you because we are talking about real world investments, a loan or a stock. Risk has to be at the back of your mind. We'll stay away from it in an explicit manner, in the explicit treatment, but bring it forth as we go along. So let me ask you this, very simple. Let me draw a timeline. One bond, 1 year from now, gives 1,000, and it's government. The other government bond gives you 10 years from now, 1,000. Which of these is perceived to be more risky? So suppose you just bought this bond and you are at some point beyond zero, and you bought both of them. Whose price will fluctuate more? Think about it, very simple. Whose price will fluctuate more, and because of what? You know the answer to almost 99% of the questions, right? The answer is compounding. So this will fluctuate less. And the reason is its price is simply 1 plus R. 1,000 divided by 1 plus R. This price is 1,000 divided by 1 plus R raised to power 10. So imagine how R changes. If for a government bond which doesn't have much risk, hopefully, the main reason R is changing is because of inflation. Remember I told you R's job is to keep up with inflation. So the main reason is inflation, and there's a little bit of what we call real return built into it. So if the interest rate goes up per period, what happens to 1 plus R versus 1 plus R raised to power 10? 1 plus R raised to power 10 is going to be much larger than 1 plus R. So the price of a 10-year bond fluctuates much more than the price of a 1-year bond. And maybe we may have to sell these bonds at some point, right? So because of that, what happens is the interest rate built into a 10-year bond has to compensate me for risk, because I am risk averse. I don't like risk, right? I being the average person. In fact, everybody almost in the world, right? So what happens? The interest rates are higher for 10-year bonds, and that's why the yield curve is going up, right? That doesn't mean always going up. There's a second component, is how much do we expect the interest rate in the future to be and stuff like that. But I just wanted to give you a flavor of this, and we'll talk about it and see some data later. Okay. Now let's move away from zero coupon bonds to coupon paying bonds. And the reason I'm going to coupon paying bonds is this is the nature of most loans, that most loans don't just borrow, you don't just give money today and then pay it back one shot right at the end. Most loans, even corporate loans, have coupons built into it. So let's start with government bonds. Most government bonds do have coupons. So, and it's the most common type of bond out there, okay? These bonds pay periodic coupons and a larger face value at maturity. All payments are explicitly stated in the IOU contract. Okay, so this, we talked about the fact that this is an IOU. So the difference between a zero coupon and a coupon paying bond is simply the coupon part. Okay, and we'll just do some examples. I'm going to spend a lot of time on this example, and I think you should stay with me. And the reason is we are not doing something profoundly different than what we have just done. Having said that, the mechanics and the intuition of this is very important. And I'll take a break when we think we've gotten over the first few steps of understanding this. Okay? So does everybody please pay attention to this for a second. Suppose a government bond has a 6% coupon, a face value of $1,000, and 10 years to maturity. What is the price of this bond given that similar bonds yield an annual return of 6%? What if the similar bonds yield 4%, and what if they yield 8%? So let's, before we take a break and you get away for coffee or just go for a swim, just let's go through the mechanics of this a little bit and try to understand what it's talking about. So what I'm going to do is I'm going to develop the timeline and the formula, and then we can take a break and then come back and do the number crunching. So let's draw the timeline. The timeline is, if I remember right, how many years of this bond? 10 years. However, what do you remember about bonds? The bonds of government bonds of the US, and I'm going to stick with those because that's what the data I'm showing you, but you should be able to see this very clearly, is that they pay coupons every 6 months. And the nature of the PMT payment process determines the compounding interval. So 0 through how much? 20. So that's the first thing. What will happen at year 0.20, which is year 10? What will happen here? You will get $1,000, and this is called face value. Very clear. Till now, what are we talking about? A zero coupon bond. We just priced it. Here's the twist. It says what? You will get a 6% coupon. And many times in the real world, the word interest is used for coupon. I don't like that at all. To me, interest always belongs to the market, doesn't belong to any entity. So please, I'm going to be painful and call it coupon. And the coupon rate of 6% is this, C over F, and it's a percentage. So we know F is 1,000. So what is the coupon? Very simple. 6% of 1,000 is $60. However, although this is all written on the IOU, you know that the compounding interval is what? Every 6 months. So what really is happening is you're getting $30 and $30. And the reason is over 1 year, then you're getting $60. So 330, and the nature of this bond is such that you also get 30 at the end. So how many 30s are you getting? You're getting 20 30s, and how many thousands? 1. Doesn't this remind you of the loan? So 30 reminds you of what? The payment you pay on the loan. The only difference between this and a standard loan is this, that the face value in a standard loan is not there. You're just paying PMT, 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 PMT. Okay? So this is the nature of the timeline. Do I know N? Yes. Do I know coupon? $30 per 6 months. Remember, I have to match N with the coupon. I can't say 60 here. Okay? And what is R? R was 6% per year, which is what? 3% per 6 months. Everybody got the details? So it's a very straightforward problem to do. And the two components are this. The price today will have a PMT component, right, of $30. How many times? 20 times, and the interest rate is how much? How much is the interest rate? Interest rate is 3%. Remember, half of 6. And this is the PMT flow, and you'll do the PV of this. So this is the nature of your PMT, and you'll do the PV of this, plus you'll do the PV of 1,000 too. How many years from now? How many periods, sorry? 10 years, but periods 20, and the interest rate is 3%. So the way to think about a coupon paying bond is it has two chunks. The first chunk is a PMT chunk, a present value of a PMT chunk. The second is present value of a one shot. So you remember in the first day of class, I broke up the introduction of PV and FV into two parts. First day, we talked about single payments, the 1,000 chunk. The next day, we talked about the loans and so on, the PMT chunk. This is a combination of the two, just because the nature of the beast is such that you have a final payment of $1,000. So if you understand the timeline, the formula, and as I told you, all of this is explicitly stated in an IOU. Let's take a break and today come back and crank through some numbers. Okay? Take care. So hopefully you've had the time to kind of stare at what that bond is trying to say and so on and so forth. We did the timeline and formula. Just remember, match the interest rate with the periodicity. Always make your interval of thinking the compounding interval. And it'll be pretty obvious when you're looking at the bond or whatever the idea and so on, what it is. Match the compounding interval with the interest rate. Let's do some calculations. And here I'm going to go over to my friend, the Excel. And there's some numbers from the past which we'll ignore for the time being. So I'm going to stick in cell C. If you can see me, hopefully you're fine. What I'm going to do is I'm going to do PV. Why? Because I'm trying to do a PV of a bond. And what was the interest rate on similar bonds? Remember, it was 6%, but we are doing everything semi-annual. 0.03. How many number of periods? 20. What is the PMT? 30. And what is the future value? You can do everything. What do you notice? I purposely picked this example first construction. What do you notice? The price of the bond is equal to the face value. Yes? Do you notice that? So let's go here and I'll show you the intuition for it. The price of the face bond is the face value. That means today the price is exactly equal to the face value, even though that face value is coming 20 periods from now. And the reason for it is, what do you see the relationship between coupon, which is like a percentage, and the interest rate? They are both what? The same. 30 over 1,000 is 0.03, and what is my interest rate? 0.03. So what's happening? Very intuitively, the coupon is the numerator, it's coming to you, but time is hurting you at the same rate. So they cancel each other. And what are you left with? $1,000. So this is a neat thing that they'll say in the real world, that the bond is trading at face value, right? At par. Par, P-A-R, is face value. Let's assume now that the interest rate in the real world is actually 4% per year, which is what per month? 2%. What does happen to the price? It's gone up. It's greater than face value. It's called trading at a premium. Premium doesn't mean you're paying a higher price than you should. Premium simply is relative to 1,000. Right? Discount is relative to 1,000 too. Okay. 1163. Quick question. Why did this happen? Forget about the exact price. And this is what I want you to have in your gut. A feeling for finance, not just numbers. You know the answer has to be greater than 1,000. Why is that? Notice the coupon is still 30. And it cannot change once you've issued the bond. Because what's the coupon? Who determines the coupon? The person issuing it. And we are assuming the government is not going to default on the 30 at least, right? But what can change is the market rate that we are using. So the market rate is now 2% and the coupon is 3%. So what is going to do? It's going to make the value of the bond go over 1,000 simply because the value you're getting it at a higher rate coupon than the discount rate. Now suppose the price is such that the rate of return that you're getting in a similar instrument out there in the market is actually 8%. And half of 8 is what? 4%. What will happen to the price? It will go below 1,000 watt. And this is called selling at a discount. Zero coupons always sell at a discount. Zero coupon bonds always sell at a discount because there's no coupon compensating for it. Whereas coupon paying bonds can and do sell at a discount. But what has to be true? Let's look at the parameters. The face value is $1,000. I'm not changing that. The coupon is 30. I'm not changing that. The N is 20. I'm not changing that. I'm standing today. What have I changed? The interest rate. Now I'm hurting the bond's price at a higher rate than the coupon flowing in. So what happens? You get less than face value. So this tells you something about the pricing of bond, which is this. Interest rates go up, price goes down. But for a zero coupon bond, there's a very neat for coupon paying bonds, government bonds, there's this neat relationship where if the interest rate and the coupon rate are the same, the price of the bond has to be the face value. And then if the interest rate is higher, it's lower, and interest is lower than the coupon rate, price is higher. So let's try to take this learning and graph it. So we have done the calculations, and I would really encourage you to go back and do those calculations again. Right? So, but I'll write out what you should find. So if coupon rate is greater than R, price will be greater than face value. If coupon rate is less than R at a specific time, the price will be less than face value. And if coupon rate is equal to R, price will be equal to face value. So this is what you should find, and just mess around with this because it will help you. So what I would like to show you now is a graph. And this graph is important. Price R 0. It looks like this. So the price of a bond falls when interest rates goes up, right? That's what it's showing, and that makes sense. So if the interest rate is 6% or 3% per what? 6 months, and the coupon rate of this bond was what? 3%. What will the price be? 1,000. We just did this. Okay? One thing I really want to emphasize about this, coupon rate is not a market thing. It's fixed by the government. Don't ask me why, right? Because that's like getting into detail. It's something determined by their ability to pay periodically versus face value, right? So this curve is telling you the relationship between bond prices and interest rates. And let me just give you one little bottom line thing. Price goes down if R goes up. Second, short term versus long term. Which bonds are more price sensitive? In other words, if interest rate changes, which bonds will be more sensitive, bounce around? Which bonds? Long term. Finally, whose price will jump around most? Zero coupon or with coupon bond? And let me, for simplicity, keep their maturities the same. Whose price will bounce around more? And it's kind of related to point number 2. If you have a zero coupon bond, where is all your money coming from? And supposing it's 10 years maturity. All your money is coming 10 years from now. And you have a 10-year same face value coupon paying bond. what has happened with this bond? Some of its money is coming earlier and not all is coming at the end. So the zero coupon bond will be more sensitive to changes in interest rates compared to an otherwise identical coupon paying bond. It's not perfectly identical, but the only difference is the coupons. Okay, so let's take this break because this is an interesting point to think about, and I want you to know this stuff inside out because this is the simplest kind of bonds, and this is what the world talks about all the time. Every government issues these and so on. So we'll come back to issues related to it, but in the next chunk I will go dig a little deeper as we go farther. Welcome back, and now for some exciting stuff, just to show you why markets are important and why what we do in finance is all there. Every time I leave you with some thoughts that have nothing to do with the class, and I want to leave you with one thought. Markets are more powerful the more people are able to participate. Markets are not very powerful. They do not create value if people are left out of them. It's just like democracy. And so please keep that at the back of your mind, that a lot of us do not have even the opportunity to participate. But I want to show you how markets work and how they are just the same thing that we have been talking about. I'm going to try to prevent myself from going too long, simply because, this stuff is, we could go on this forever. But I'd encourage you. If you notice, what I have up there is the good old Yahoo Finance. It's finance.yahoo.com, and I'm going to launch it from here. And if you notice, it jumps straight, and I would just quickly browse the top part. If you look across, what is it showing? It's showing Dow Jones, which is the top 30 companies. S&P 500, we spoke about it, I think, a little bit. It's a large portfolio. NASDAQ is another exchange. But notice what's here. 10-year bond. And if it says 10-year bond unqualified, what do you think it's talking about? The government bond. And what is the chances that this bond will be paying a coupon? Pretty high. And the reason is very simple. Coupon paying bonds are much more common than zero coupon bonds. Just for some fun, there's an exchange rate here between the euro and US dollar and the price of gold. Gold fascinates people. It doesn't fascinate me very much because I don't know why its price behaves the way it does, to be honest with you. Okay, what I'm going to do is if you're coming with me, I'm going on the right panel of the site, right for me. And you'll notice there are some currencies. And this class doesn't talk about international finance, but I think that's a topic that is extremely important. And what's listed here are different exchange rates. And at some point, after this fundamental class, if I do get involved in continuing to do online, I want to do international finance. I want to do valuation with a lot of real world examples, cases, and so on. But I'll talk about that on the last day of class as to how do we go beyond. But just let's scroll down a little bit. There are commodities, which is not in the class, but they are bonds. Now notice right away, you see a 5-year, 10-year, and 30. What do you notice? In the 5-year, 10-year, and 30, the one thing has to be the case. Unless qualified otherwise, it has to be a government bond. So I'm going to now click on more bonds. And if you see, there's a whole table here. And what do you notice? You notice a 3-month bond, treasury, and the word treasury means government. 6-month bond, a 2-year bond, a 3-year bond, a 5-year bond, a 10-year bond, and a 30-year. These are not the only ones, but these are the listed ones. And what is happening to the yield to maturity? It's showing yield to maturity right now, and it's showing yesterday, last week, and so on. So let's stick with the yield right now. It's 0.05 for a 3-month, 0.12 for a 6-month, 0.26 for a 2-year. And by the way, they are all annualized so that you can compare them, right? Otherwise, obviously, a shorter interval will have a lower rate of return, right? But what you notice, even annualized, what's happening? It's almost remarkable, the steady increase in them. Can you see that? Yeah? And what is that over here? Let's go to the right side. The right side has a little graph, and this jumps out at you in whatever country you're in. This is the relationship between the interest rate or yield to maturity built into bond pricing with maturity. So let me just click on it and it will jump out. So this, if you look at this graph, it is showing you how steadily the interest rates and the yield to maturity on a bond is positively related to the horizon. And this tendency, if you dig deeper, this is a tendency, this is not a fact. This tendency all the time pushing upwards is because of two reasons. Long-term bonds are much more volatile than short-term bonds. Compounding. And we do not like that movement. Are you with me? We do not like that movement. So if we don't like the movement, what are we willing to pay? More or less for that bond? We are willing to pay less. And if you are willing to pay less, what does it say about the yield to maturity? Has to be higher. So remember the one thing, yield to maturity goes up, price goes down. The whole thing. So what I'm going to do spend a little bit more time on this just because we are talking about bonds. And when we do stocks next week, I'll come back. But bonds problems are very interesting. So this table we just saw. And look, what are these? US Treasury. Now look, rated municipal. Why are they rated? Because these are issued by municipal governments, local governments, and bonds. And they too are rated because the probability of default is there, built in. Now the question here is, the maturity is increasing and the tendency of the interest rates to increase with maturity is there, right? But what you also notice is something which should be pretty obvious, is that the municipal bonds in the US are taxable, tax exempt, whereas treasuries are taxable. So what you'll notice is everything else the same, that tax thing should come through. But we are not talking, I'm not interested in municipal. I'm much more interested in showing you something which is peculiar to the US, largely. Corporate bonds. And this has been a subject of a lot of pain and a lot of anxiety continuing to be the case. And the reason is there has been a lot of turmoil in the financial markets. So if you notice what's going on is you have ratings, right? So which is the highest rating? AAA. So if you look at all these bonds, what you'll notice is there is a positive relationship. The higher the rating, the more you're willing to pay. And therefore, the return you're willing to get is lower, right? So look at these last three bonds. As the rating goes down, the yield to maturity goes up. And the reason is very simple. The yield to maturity is fixed for all three, right? And why is the maturity is fixed. Why is the yield to maturity going up? Because in order to entice you to buy a low rated bond, and given that you are risk averse and I am risk averse, we are willing to pay less, which means automatically we want a higher return. I told you I'll start talking about risk and return. So this is the relationship between the two typically. One last point, and do it on your own. Go to Yahoo Finance page and do the following, answer the following question for me. Which bond will pay a higher rate of return? A corporate bond or the government bond? As long as I fix what? To be fair, I make them identical in every other respect. So at least make the maturity the same. And you should know the answer. And next time, what we'll do is we'll review very quickly what we did in bond pricing and we'll start on stocks. And stocks are the most fascinating thing created by humanity. And I want you to also recognize, I will take the opportunity to show you value creation and destruction using stocks. I cannot do that too much with bonds because bonds are boring. You buy bonds only if you know what they're going to pay in the future. And I believe unless we all take risks, we are not going to be able to do good stuff. So risk taking is inherent to value creation. You don't want to take too much risk, but you have to take some risk. So I'll come back to this. I want to remind you, however, please go to the problem sets and assignments. I have built-in assessments here. When I do a problem, I ask you to do it and then do it with you. So I'm not too worried about the video assessments because I think everything I do is with an example and you do it with me or on your own time. What I'm really want to test you on assessments is in your assignments. So please do the assignments. Please redo all the problems. Make sure you got them. You can go back to the video. Take the problem, do it, go back to the video and see if you got it right. See you next time. Have fun. I'm calling this bonds and stocks still because I want when there's a connection across 2 weeks, I like to carry both issues. For now though, just for the sake of, so that you're thinking that we have talked about this, we're going to focus on this. The reason I'm carrying both is both are forms of fundamental financing. So now we're going to go to stocks. And bear with me, I'm going to get excited and I'm going to get really, really into it, hopefully. Not that I'm not usually. But what is a stock? What is equity? What are shares? What an animal is or a thing is extremely important to understand before getting caught up in numbers. So let's look at it. Boring part. What is it? Another form of financing. If you gave me that answer, I would have to say you're right, but it's not very uplifting. You know, we already know that. How is it different from a bond? So think about the word equity, stock, share. It doesn't necessarily show a contract or a relationship that's as specific. So we know what a bond is. A bond is a contract. If I don't know how much you're going to pay me back in the future, I'm not going to sign up and give you money today. Is it an IOU? Really? So now let's think about a stock. What is a stock? Is stock an IOU? Really? Answer is maybe. So let me show you what a bond does. And this is so fascinating. Here's a bond, and let's stick with our long-term bond. It says 10 years, and in your head, what are you thinking? 20 periods. It says face value 1,000, and says coupon rate of what? 6%. So you know that actually 10 years is 20 periods. You know 1,000 will come at the end, and you know that every 6 months you'll be paid 3%, which is 30. This, to me, is an IOU. So suppose this is issued by, say, IBM. You know the entity that's issuing it, and you know that rating companies will tell you whether it's a good bond, AAA, whatever. I want you to recognize, though, the relationship between the yield to maturity of the bond and the risk of the bond is a very intimate one. And I want you to remember this. I'll say this many times. There's no such thing as a good risk or a good return. Risk and return match each other. And this is one of the things that it's very, very profound about finance. You get what you pay for, typically. So this is an IOU. What does a stock say of IBM? Same. You get a piece of paper, sure, it says you own 1 share of IBM. Now tell me, is that an IOU? The beauty about this is you're willing to give money without a promise. And that's so awesome. Think about it. I know the Wall Street and financial markets and financial institutions are getting beat up by the public. And I think, in my view, you have to remember this very clearly. One of the most awesome things created by people, by us, is a stock. A willingness to give money without a contract in return, right? It's the most fascinating thing created. But it's like the ring in Lord of the Rings. It's a good ring, not a bad one like that one. However, everything great created has been abused by humanity. And that, to me, is not the problem of the stock, it's the problem of humanity. Okay? So let's keep going. Who gets paid first? So you are a company who's going to borrow, you issuing a bond or directly from a bank, and you also issue stock. But who gets paid first? The contract, the bond. So what does the stock get? Whatever is left over. How are you paid back? And this is the definition. You get paid back in 2 ways. For a bond, what is the periodic one? Coupon. Here it's called dividend. What is the other way you get paid in a bond? You get the face value. But what's the difference between a bond and a stock? A bond as a contract has an end. A stock doesn't have an end. So if you want to end the stock, what do you have to do? Remember one thing very simply. You always control things. Don't let others control you. You could always sell the stock. So selling price. And this could be a capital gain or a loss. Let me just share a couple of things about this, and we'll get into detail. Companies do not have to pay dividend. It's not a contract. Similarly, companies don't know their own stock price in the future. So they're not promising you anything, yet you are investing. And the reason is very simple. This is how most value is created, by taking on new ideas, new risk. Does equity have a life? Answer is what? No, fundamentally. Of course, do companies disappear over time? Yes, they do. In fact, that's the beauty of competition. Competition, if let loose, means that you will not survive forever. However, you have to recognize that when stocks are issued, they are not a contract. So unlike a bond, they don't promise you anything, and unlike a bond, there's no finite life. Now tell me, what else in life except love is similar to this? Where you give in the expectation of getting, but you don't have a contract signed, right? That's what I really like about stocks. Stocks is our ultimate belief in the future. And clearly you want something in return, right? But it's not. You don't want to tie down and make it a contract. So just so that I get into this a little bit better and get you a feeling of what's going on, and believe this is far more important than understanding the mechanics of things. Both will be covered in this class, but not. So let me repeat some things to show you the beauty of bonds and stocks. Okay, so equity also is called stocks, and we have also started off with, we know what bonds are. So here's the thing. Where is value created? Quickly. here. This is where value creation happens. And the thing that is your idea does is it generates cash flow. Cash flow. Right? Do you know what it's going to be in the future? Answer is no. And that's the beauty of it. Because things are not known, the cash flow bounces around. But the cash flow is generated by your real asset, your ideas. Then what happens? You have to finance it. But when you go financing it, you start with equity always. Because why would anybody give you a loan if you don't have your skin in the game? So typically when things start, entrepreneurs start, they put in their own money, their family money and so on. I'm doing a fascinating venture fund at the Ross School of Business as part of a bigger structure. And what we do is we try to invest in companies that are creating value and also having social impact. And the reason I'm bringing it up is equity investment is the first thing any entrepreneur does and borrow and gets from other people to participate in. Okay, so the equity happens, and what is happening? You're giving up your resources or money in the creation of value over here. But then many companies also have debt. But this is what? This is an explicit contract. So just recognize one thing. If I make $10 million tomorrow, who gets paid first? First of all, very obviously, this guy, because it's an explicit contract. Then what do? We pay the stockholders. But we may not necessarily pay the stockholders. In fact, let me give you an example. If you think of Microsoft in 1980s, 90s, the one thing you'll see is it never paid dividends, never paid out anything. Yet the price kept going up. And we'll talk about these issues in a second as we go deeper down this week. But I want you to recognize that just because it's paying out money doesn't mean it's good news. In fact, companies with great ideas do what with that 10 million? After they paid the bondholders, they reinvest in better ideas for the future. Okay, so we'll talk about that in a second. But the point I'm trying to make here is the key difference is you generate 10 million from your idea, existing ideas, you first pay off your bondholders. Last point, very important. In generating your real asset value, your cash flows, remember how did we go from cash flows? How did we get cash flows? Revenues minus costs minus capital expenditures and so on, right? Each one of those is also a contract. Why? Because if you are working in a fair competitive market, every supplier should have a contract and revenues generated through contracts. In fact, if you walk into a store, the price should be on the commodity. That's a contract already. So why I'm raising all these important issues is everything on that snapshot is a contract, except what? Stocks. And that's why it's one of the most fascinating things to understand and to see a thriving market in. And I wish almost all of us had the ability to own the future of what we collectively are trying to create. And I repeatedly come back to the issue. Stock markets have done great, but the day they are the greatest, it is when almost all people in the world have the opportunity to participate. So it's like it would be better than elections. Okay? So what I want you to do now is, just before we get into the pricing, I want you to take a little break, think about what I've just said, because what I've said is not simple, is not widely understood, and is extremely important to jumping into the pricing of a stock, because we are going into la la land now. We are going to a dimension where things are not written on a piece of paper. We have to use our imagination. See you soon. Bye. Welcome. As I said, a stock or a share or equity is such a new thing for most people that even people who actually trade it don't pause to see the power of it. So what I'm going to try to do now in the next 15-20 minutes is give you a sense of how you would think about the pricing of a stock, how would you value it. So the first thing I want to introduce is some ideas about the pricing. So the main goal is how is the stock priced. I'm going to give you some concepts or more some ways of thinking about it. So P naught is the price of a stock today. Quick question. Do you know this? If you go to buy a stock, should you know this? Answer is absolutely. You should know how much you're paying for something. So it's, in that sense, it's like the price of a banana. But it's really fascinating though. So the price of a stock today we'll call P0. The price tomorrow we'll call P1. No big deal. However, the word expected, remember now I'm pulling risk into the main part of our brains, a little bit more active. Next week we'll start talking about it pretty actively. So the expected stock price, why? Because I do not know it today. And if you do, you don't need this class. Everybody's trying to figure it out. And we'll talk about that too. But let's call that P1. Let's assume that the expected dividend at the end of year is div 1. Remember, I told you, dividend is like a coupon. The only difference is what? It's not a contract. So if a company doesn't pay a dividend, it doesn't mean anything. Whereas if you promise to pay a coupon and you don't, it's a contract and you're effectively in default. Okay? Again, why expected? Because time one hasn't happened as yet. Now, I'm going to show you a timeline again, but a stock is expected to live a very long time. So what I'm going to do is I'm going to do one period at a time. And the reason I'm doing it is because it's very reasonable to think of something one period at a time than a whole long stretched timeline. Having said that, let's draw the timeline because it's important to understand what the heck is going on. So very clearly, I'm standing P0 and the goal is to try to figure P0. i.e., how would I value a stock? Stock goes on what? Hopefully, when you issue stock, you don't want it to stop. You're the entrepreneur. By the way, every entrepreneur should think like that they'll live forever. Their idea will live forever. Okay? So you go on. What have I done now? Instead of trying to look forward and figuring it all out once, I'm putting it into bite-sized pieces. So I'm forcing you to think of only this first period. Okay? So for the time being, just ignore the future. But keep this timeline at the back of your mind. That the future is there, but I'm just ignoring it for the time being. But actually I'm not. And you'll see the key to that in a second. Okay? So let's see if we get this right. Turns out, if you're thinking one period at a time, the price today will be dividend at the end of 1 year plus what? The price at the end of the 1 year. Remember what I told you. What you could do is, you could say, man, I don't want to deal with this long period of time. I'm going to sell this stock after 1 year and try to figure out what price today should be. Now, turns out, does this make sense? Sure. Imagine this is the last year or last 6 months of your coupon paying bond. What is the first thing? The coupon. What is the second thing? The face value. The difference is that you do not know the price of your stock 1 year from now, or sorry, 6 months from now. Whereas if you had a government bond or a corporate bond and you had only 6 months left, you know that P1 is what? $1,000 or $100, whatever the face value is. Does this help, right? So you are now in a zone where you know that you have to somehow figure out what the value of dividend and price is in the future. Not an easy challenge, but as I said, today we'll focus on what the heck is going on, and then we'll start using numbers. Okay, so what is expected P1, right? So remember, and I'm going to write this, that P naught is equal to div 1 plus P1, but in which period is this? If I hold it for one period, I have to discount it by 1 plus R. Let's just talk about cash flows and discount rates. Do you think I've gotten both in the formula? Answer is yes. Dividend is one form of cash flow. What is the other form of cash flow? Me selling the stock. Okay? R. What is R? Remember, R is what? The best alternative investment of the same risk. So if you are evaluating, say, Kmart, you cannot use the stock of Apple to figure out what the rate of return should be. They are different animals. And we'll explicitly get into it when we talk about risk. So the question I'm asking is, what is this P1? So imagine thinking in the head of P1. What is P1 thinking? It's one period forward. What would P1 be? I'll let you pause and think about it. Again, time travel to time 1. What would P1 be? Go one period at a time. Think about it. What would P1 be? P1 will be very similar to P0, but removed how many periods? One period. So P1 should be this, and I'm going to write it and you see if you agree. So have you seen comic books, right? And there's what is Snoopy thinking? So if P1 is a comic character, what is it thinking? Who am I? It's Googling, who the heck am I? P1 has to be the present value of what's expected at the end of the second year, right? We're going logically. So what is div 2? What dividend will be at the end of period 2? What is price 2? What will the price if I sell it at the end of the second year? But now what do I have to do? I have to bring it back to year 1, so I discount by 1 plus R. Does this make sense? I hope it does, because this is key to understanding stock pricing. In some senses, it's a building block approach to what we already know. Whenever you have a tough problem, break it up into bite-sized pieces. The key element here is, please do not forget that this is all expected. We are ignoring risk explicitly, but the fact that something is expected means this is not known today. So let me ask you this. Standing today, do you know div 1? No, it's 1 year from now. And unlike a coupon, it's not promised. Do you know P1? No. In fact, P1 is even more complicated than div 1. Why? Because when you think about P1, what is P1? P1 is what div 2 plus P2 would be discounted one period back to year 1. And I apologize, I used the cap R. Let me use a lowercase r to be consistent. And while I'm doing it, what is the assumption I've made? That the per period rate of return built into the pricing of this stock, whether it's IBM share or Google's, is not changing. And you can, that's a strong assumption, but imagine you're standing today, you don't even know for sure what's the rate of return for 1 year. Figuring it out, how will it be different in year 2 is a little bit tricky. So we are going to assume that the rate of return, which is largely based on the riskiness of this animal, is roughly stable and the same. Okay? So let us see what is P naught then. So you just saw that I've given you a flavor of thinking. So tell me what will P naught be? Let's modify P naught. And by the way, I'm going slow here simply because this example, simple quote unquote derivation, is the most famous formula ever in finance. And finance is the most awesome thing. So it has to be the most famous formula, even more famous than E equals mc square. Okay? Take it or leave it. I believe it. So P naught will be what? Let's write it. Is div 1 stay the same? Yep. Because I'm just staring at the numerator, at the top part of this equation. So remember, I'm substituting for P1. So let's substitute for P1 plus div 2, sorry, I'm forgetting the I in this, divided by 1 plus R. So I've substituted for P2, but what do I have to do? I have now to discount the whole thing by 1 plus R. So what have I done? I've just taken the value imagined about what P1 would be and substituted it. Can I expand? Sure I can. So let's do it. I'm a little cramped for space, but we'll manage. Dividend in period 1 will be divided by how much? Notice I'm dividing by 1 plus R. 1 plus R, why? Why not R? Because this is a 1 period discounting. That was easy. But now what do I have? I have div 2 divided by 1 plus R and P2 divided by 1 plus R to bring it to P1, right? But now I have to discount it twice, right? So why? Because div 2 is how many periods from now? 2 periods from now. So look how cool this formula is. It makes so much sense. It's div 2 divided by 1 plus R divided by 1 plus R, which is 1 plus R square, plus P2 divided by 1 plus R square. Isn't this so logical? So think about it. Think about it now in the following way. What would be the price of the stock if I suddenly changed and added one more period in my mind? So earlier we had started off with what? In this specific formula, we had done the thought experiment that we are going to sell the stock after 1 year. Let's do the thought experiment that we are going to keep the stock for 2 years. What would be the price today? Well, it has to be the present value of what's happening in the 2 years. In the first year, the stock will give a dividend, 1, and I'll discount it for only 1 period. In the second year, it will give dividend 2, discounted by 2 periods, therefore 1 plus R square. And also, I'll sell the stock for P2, 1 plus R square, because it's 2 periods away. This is so logical. That's what I love about finance. There's no bringing in some other factors suddenly that we never heard of before. It's tough, it's difficult, but it's very logical. And the difficulty and the toughness of this example is not coming because of some profound mathematical thing. It's coming from a simple fact. Quick question, do I know div 1? Remember, I'm standing today, P naught. Do I know div 1? No, I don't know div 1. Do I know div 2? No, I don't know div 2. Do I know P2? Heck, I don't know P2. Right? So actually, if you look about it, I should do this. What does E stand for? The expectation that I have today. Similarly this, and similarly this. I am expecting to get paid, or if I get paid, this is my expected value. This is so important that it's not for sure, and therefore talking about stocks without talking about risk is kind of pointless. But I'm not going to be explicit about risk except the fact that these are not real things. These are what I expect. Quick question. During the technology boom, something dramatic happened. And it was the following. Firms used to pay dividends regularly in the firms that are existing in the world at that point. And suddenly, lot of technology firms and lot of dividends are not being paid. And we'll see why. But look what has happened as a result. Would you call a stock any kind of contract? No. But what's fascinating about it is that if you really understand what a stock is, you understand what value creation is. Because the tragedy of a bond is, it cannot be a participant in value creation, I mean a beneficiary, because it has agreed to give money only with a contract in hand. So who gets to gain from the value creation? Stockholders. Who gets to lose from lack of value creation of an idea? Again, the stockholders. And who's the ultimate stockholder? The entrepreneur who starts it all. So I'm going to show you some further developments of this formula, but I want to make sure that we are all on the same page. So I have done this, and this is what the formula continues. If you keep substituting in the future and go from 2 to 3 to 4 to 5 to n, this is what the formula looks like. Hopefully you can do it on your own. In fact, this is the one time I would encourage you to take a long break to mimic and understand what's written over there. Create your own notes, think through this, be careful, but not too careful where you're not getting the non-expressible beauty of what a stock is. So what is the stock? Imagine now you're holding the stock for n periods. What is the coupon? Not for sure, but that it could be paid is div. How many of them? N of them. Are they being discounted appropriately? Yes. Because if the period is 2, you're discounting by 1 plus r square. If the period is n, you're discounting by 1 plus rn. What the heck is Pn? Pn is the price at which you expect to sell the stock after n periods, right? So I've separated the two out. The first, and by the way, don't get too worried about that summation sign. The first is just summing up all the dividends and discounting by the period. So if n is 1, that means you're discounting 1 period and so on. And I have separated out Pn from this whole thing. And the reason is very simple. If you think about this, and this is 20 years or 20 periods, and it's the bond we talked about, what is div 1? In our example, the coupon was $30. Coupon. Known? Yes. What was Pn for a bond? It was $1,000, known in advance, and we call it at face value. Why? Because it's written on the face of the thing, right on the IOU, $1,000. Now, what's the difference between this and this? So even if there are 26-month periods left, the first is I don't know whether the dividend will be paid or not. If so, by how much? I certainly don't know what price I'll be selling it at. Let me ask you this. What will Pn be? Will Pn be anything to do with the past or the future? Well, Pn itself, if you have finance in your blood, which I'm sure you do, will be the present value at that time of everything beyond period n. So let me ask you this. Let's keep expanding. Let's come to the first most important concept or formula plus concept plus beauty of a stock. What is the price of a stock if n is extremely large? In other words, the stock is expected to live for a fairly long period of time. Imagine how long has Ford been around? Long time. So when n is large, what will happen to the value of Pn today? Let's stare at this and we'll be done in a second. What will happen to this as n becomes close to this guy. What is this guy called in math? Infinity, meaning very far away, right? What will happen to this? This guy will tend to 0. Why? Because of pause compounding. So what are you left with? You're left with finite parts of this, and that's what this formula is called. And we are going to take a break in a second, but I want to show you what this amounts to as n goes to infinity. And this, by the way, is the most famous formula I have ever seen, and it's ingrained in my being. And that is, the price of a stock today is the present value of a bunch of dividends way out into the future. And the reason there is no finite price in the end is because its present value is essentially going to be 0. Does everybody get this? Please spend time on this. Please think about it. I have gone through the concept, and now I'll go through the example upon example upon example. And the reason I'm going to do examples is twofold. You need to internalize this. And also, stocks are the most fascinating way of showing value generation people could have thought of. Because there's no contract, there's only expectations, there's risk taking, and there's value creation. See you in a little while or a long while, depending on how you feel. I would encourage you to read, think, before doing the examples we do together. See you soon. Hi, I hope you have had a chance to kind of carefully review what we did just before this break I took. And I wanted to remind you that these breaks are more to kind of give you my sense of where you probably need to stop. But remember, this is you in many different ways of learning. There are lots of you there. So it's up to you too to always take a break. And if you don't understand something, you have other resources, so you don't have to go through these videos till you feel comfortable moving forward. I'm emphasizing this right now because the idea of a stock is not easy to comprehend. So let's just quickly look at this formula. What this formula says is basically what we know about cash flows, is that if you have cash flows going on for a long time, you will have to discount them at an increasing rate because of, again, compounding. So that's all that it's saying. Why dividend? That's just a name for the way the stock pays stuff to you, right? Like, for example, for a bond, it was coupon and then face value. Why is no face value here? Because you expect when you buy a stock that the stock, even if you're going to sell it, is going to have value. And when you sell it, the only way it will have value is if it's expected to move on, not just die. So this inherent built-in value coming from looking forward is extremely important to internalize. Okay, so at any point, a stock, unless you know for sure is not going to last really long, has value because of the longevity there is. So that's a point that you need to understand, and we'll emphasize. What I'm going to do now is I'm going to start giving you examples, and I'll stop, take breaks, but you take breaks, as I said, whenever it's convenient for you. Okay, the special case of a stock, which is I call a dividend stock, and I think many people in the real world would probably call it an income stock. This is the kind of stock that kind of gives you a steady flow of quote-unquote income. And the income paid by stocks is called dividends. So let's look at a special case. Suppose dividends are expected to remain approximately constant. What would be the price of a stock? So the notion here is that if you remember, I talked about a little while ago, I think it was, but when I was doing annuities and so on, I just introduced the concept of a perpetuity. So what is this saying? Generically first, it is saying that you're standing here and you're getting approximately the same C, cash flow, and for a very long period of time. Okay? The only twist here is that we'll call this cash flow dividends. So the question is, what is the formula for this? Turns out, and if you have the time, you can do these calculations for yourself and derivations actually for yourself, but I think it's very cool to derive this. But imagine the formula is the simplest possible. C over little r. I apologize because I sometimes use big R, little r, but R, unqualified, means the discount rate or cost of capital. And quickly, one more time, where does it come from? It comes from your competition. So whenever you're thinking little r or your cost of capital, you're thinking market. If there was no market, it would be very tough to figure out your value because values are always relative. Okay? So C, in this case, it becomes div over R. So this is the formula. What I'm going to do is I'm not going to try to derive it for you. And this is where I think you need to put in some work based on the level of curiosity you have. And you can look at the books I've recommended to you, or you can sit down if you're curious, just derive it. And remember, this is equal to what? Div 1 plus r plus div 2 1 plus r square, going on for a long time. In fact, perpetuity is almost infinity. The only constraint I'm putting on this is these two guys are the same, approximately. And why do we use these formulas? Because remember, a stock, you don't even know what the dividend is going to be in the first year, second year, third. So getting too precise can be actually hurtful to your thinking. You're doing a very detailed calculation on stocks. Doesn't make that much sense. So we will use formulas like these because they kind of capture both what's going on and in some sense what's happens in the real world. Okay? So this is basically the formula. And let's go back. So we know that if it's dividend is stock is a constant level of dividend, whatever it is, let's do this. Let's spend 5 minutes and you do it with me. And I'm assuming when the problem is relatively straightforward, we kind of do it with each other. Otherwise, just take a break, do it, and we'll come back to it. And I will try my best to make sure that I'm making a good judgment about what is doable together and what is you want to do a little bit of a break and test yourself. And remember, you have always the opportunity to go to the assessments and assignments to do similar problems and then come back. Okay? So this problem is relatively easy. It says, suppose Green Utility is expected to be a dividend, to pay a dividend of 50 cents, not to be a dividend, but to pay a dividend of 50 cents per share for the foreseeable future, and the return on the business is 10%. What does this mean, return on the business? It means another way of saying that the cost of capital belongs not to you, not to anyone, but the type of business you are in. And that return is a function of demand, supply, and everything put together. What should be the price of the stock? Now, just take a pause, think about it. I'm going to start scribbling stuff on the board. So what is it timeline-wise? Very straightforward. I'm getting 50 cents dividend for long, long time. And I'm asking you, what would the price of the stock be? And I'm calling it a utility because it turns out utilities are regulated. And it's very common to view them as income stocks. as opposed to another example I get into, which is at the heart of the rest of this session this week, is called growth stocks. And I just love that stuff because it will convey to you what really is going on and how growth is good, how growth could be bad, and so on. But let's stick right now with the stock that's not planning to grow, but is planning to pay 50 cents. You know the formula for this is what? 0.50 over 0.10, which is div over R. We just did. Right? What is that? 0.5 over 0.1 is the same as what? Multiplying by 10. Why? Because 1 over 0.1 is same as multiplying by 10 when you're dividing, right? So this is $5. So this was pretty straightforward, right? What I would encourage you to do is think about how easy this is to value, right? So you took 50 cents and you just multiplied by 10 and you got $5. And it's basically that. And people do this when you're comfortable with this level of the assumptions behind the ease of the formula, you just suddenly realize how cool it is, you know, how people are so comfortable with numbers seemingly in the financial world. It's because they use formulas like this. That's what is ingrained at the back of my head. And therefore I can feel very comfortable. It's not that I'm very comfortable calculating complicated formulas with numbers in Excel. In fact, I shouldn't be. You know, I have better things to do. Okay, so let's just see what does forever mean. Now many people get caught up in nothing is forever, how could it be forever, this is not quite real. Okay, so let me ask you the following question. Let me assume that forever means 30 years. And by the way, that's not terribly long, right? A lot of companies do survive 30 years. That's not the important point though. We are trying to price a stock that is not expected to die tomorrow because there's no point doing that, right? So let's take this example, same example, and say, okay, Gautam, come in, forget about this perpetuity stuff. Doesn't make sense. So let's just assume it lasts for 30 years. And the dividend is 0.5. And so what am I doing? What is this called? Have you done this before? I think we have, right? What is this called? This is called an annuity of 30 years. The only difference between an annuity of 30 years and a perpetuity is the perpetuity is going to go beyond year 30. Okay? So just recall, what was the value of the perpetuity? It was 50 cents divided by 0.1. Very simple. So 50 cents multiplied by 10 was $5. Keep that at the back of your mind. And now let's do this on a calculator. You see what's going to happen. You can't do this in your head. And that's part of the value proposition I was talking about. So let's go to an Excel. Let's do equal sign, and what are we figuring out? PV. I'm actually much slower than you probably by now, and you guys are just rolling along with this stuff and saying, Gautam, come on, go fast. I don't type very fast. That's the way I am. Oh, anyway, so the rate is 0.05. That can't change. And how much am I? Sorry, rate is 0.1. Right? There you go. I'm talking and I'm messing up numbers. The rate was 10%. I think I got it right, 0.1. The number of periods was what? Not infinity, I don't like that, but 30 is fine. And how much was my money? 50 cents. And I hope my fingers haven't done anything bizarre. What's the answer? Or what's the value? Look, it's $4.71. Why did I do this? Let's go back. So what's the value if I use an annuity? Value is 4.71. Let me ask you this. Are you sure for the next 30 years you'll get that dividend? Because if it was exactly true that you expected it and you got it, there's something really magical about you or the real world. The real world doesn't operate like that. It's approximately that, right? So getting very precise about $5 for 50 cents for 30 years would make sense if you were exactly sure that it's going to happen. But why be so precise about something that you kind of feel will happen? So this is a very powerful way of showing you the value of a perpetuity. How much did we calculate the actual perpetuity? And this is, by the way, seemingly a very simple example, but it's a very deep issue, right? So this shows you why finance is both art and science. All your numbers are wrong. So what's the point getting very precise about being wrong, right? So let's compare these two. Am I close when I did a perpetuity of $5? Yes, I'm pretty close. Which was easier? Heck, I could do the $5 in my head. I just multiplied 50 cents by 10, right? Okay, now annuity of 4.71. It's for 30 years, right? So tell me what is 29 cents? 5 minus 4.79 is 29 cents. If you could think for a minute, tell me what that is. And it'll kind of make you pause about what's going on. It's the present value of the 50 cents in year 31, after that forever. So getting 50 cents forever on the face of it should be what? Infinity. But you see now the power of, pause again, compounding. At a 10% rate of return, the money that you get after 31st year is almost trivial. It's only 29 cents, even though it's forever. So recognizing that the interest rate is positive, and for stocks are risky relative to bonds. They're likely to be high. You know that formulas like perpetuities will bring you so close that you don't need to necessarily be very precise. I am not saying don't use Excel. I'm saying most of value of the framework comes from your thinking, not from your answers. They're all wrong. I hope you found this little example very useful, because formulas like C over R are used all the time. They are bases of what are called multiples in finance. Venture capitalists, people in iBanking, people who value stocks, don't try to get too precise. On the other hand, bond pricing, I just touched upon a little bit, can get very, very technical and precise. And the reason is there's uncertainty only in one thing. Fundamentally, right, in government bonds, for example, if you expect the cash flow to be paid, the uncertainty in interest rates is driving everything. So you can get really precise in trying to model that. But anyways, here in stocks, everything is uncertain, right? So what's the point getting too precise about pretty much everything, because you can't. Okay. Now let me move on to something that's much more interesting in my book. Suppose dividends are expected to grow at the rate of G per year. What is the price of this stock? And this is called a growth stock. And I'm sure you have seen examples of these and things happening as we speak. Which is the biggest company in the world right now in terms of value of their stock? Remember, when I say value of a company, I could mean many things. The first thing I could mean is, being a finance guy, what is the market cap, which is the value of their stocks. But companies also have debt. So when I say value of the whole company, people would want to include debt, which makes sense, okay? So anyway, so which is the company whose stock value is the most in the world? It's Apple. Apple has almost gone and survived, almost died and survived, and then grown rapidly in different phases. So I would call it a growth stock, but it depends on where is it in its life cycle, or new idea generation, regeneration, or whatever. Okay? So let's see how this would be priced. Look what I'm saying here. Your P naught here, where the first dividend is div 1. You can also call this generically C1. You see, that's, I told you, the nice thing about finance is once you know time value of money, then we'll do risk at a fundamental level. You can do any problem, because the beauty is the same framework, same tools, just the symbols change, the names change. Okay, so the first is C1. What is the second one? Div 2. So why am I labeling them now with 1 and 2? And I didn't do so before, because the numbers are changing, right? And in this case, div 2 is div 1 times 1 plus g, and so on. Now obviously we'll see, and I'll show you the formula again. It looks very similar to the previous one. Let me first show you the formula, but remember generically what will div 2 be called? C2, and so on. So let me write the formula down, and then we'll, by the way, this is the only formula where I haven't derived it for you, and the reason it'll just take up too much time. The generic formula is C1 over R minus G. What is G? It's the growth rate in your cash flows. In this case, expected dividends. What is C1? The first cash flow. So this is very important. First cash flow is C1. The G is the growth in G, the cash flows, not in R. R is already a percentage, right? So these are both percentages. R and G are both percentages. So I'm not subtracting dollars from a percentage, okay? And what this, to use this formula, it makes sense to do what? If R is greater than G. If R is not greater than G, what will you have to do? You'll have to go the long way. So do C1 divided by 1 plus R, C2 divided by 1 plus R square, till such point that R is greater than G. And that will always happen. Think about it. If G was greater than R, you would own the world. It's not possible in steady state. But those are things that you'll get to practice in your assessment. So let's call this the formula and replace it by div 1 over R minus G. Okay? And I'm going to use examples where R is greater than G. But as I said again, don't use a formula when it doesn't make sense to use. For example, if R is equal to G, what are you going to do? Sit there, stare at the formula, you have something divided by 0. Go figure. You use the long method. Okay, and that's what another thing I don't like about the way we get taught math and algebra is we are never taught in a context. I shouldn't say never. I was lucky in high school. I was taught math always in a context, and I benefited so much by it. Instead, many times we are taught stuff and all we see is the backside of the person teaching, and that's not very interesting. Anyways, okay, so let's get started with the formula, and I'm going to now let you take a little while to do it. This is a good time to take a break, but let's first read the formula. Suppose Mughal Inc., and apologize, my sense of humor is limited, is expected to pay, Ryan is laughing with me, is expected to pay dividends of 20 per share next year. You see how I have to specify the first dividend. And the dividends are expected to grow indefinitely at a rate of 5% per year. Again, the word indefinitely doesn't literally mean forever, remember? We are using formulas as an approximation. Stocks of similar firms are earning an expected rate of return of 15% per year. Why am I saying this? Because I want to repeatedly remind you that the 15% is not owned by you. In fact, it doesn't belong to anybody. It belongs to the marketplace. Businesses get different rates of return due to a fundamentally different set of risks, and we are going to get to that next week. What should be the price of a share of Mughal Inc.? Okay, so just take a minute, try to do it in your head. When we come back, we'll do it together and see how easy it is. Okay, take a break. See you soon. Hi, I hope you have had some time to think about this, but not too much time, right? Because this is not that difficult. So P naught has to be div 1 over R minus G. And I repeat again, take the time to figure out this formula. The key is if you know this formula, you know every other formula. Pretty much you can derive on your own. Div 1 over R minus G, the first number is 20. The R minus G is what? 0.15 minus 0.05. Look how I've chosen numbers very neatly. What's the answer to this? 200. So the price of Moogle should be $200. Why? Because div 1 is 20 over 0.15 minus 0.05. Just remember though that 0.05 when you're doing this in the real world has nothing, is a percentage, it's not in dollars, has everything to do with the cash flows. Okay, so this is pretty straightforward. And now let me tell you something about myself. So do you think this is an easy division, 20 divided by 10? I mean 0.1 or 20 multiplied by 10. So this was several years ago, and I had my daughter was just maybe a year old or whatever, and so I stopped, and she was really hungry, and we were driving somewhere. So I said, I'll run into the store and pick up a little carton of milk, and I'll get it for her, and she'll be fine. So I'm running out, and I put it at the counter. And I was obviously I was a little anxious that she's crying and so on. So I put it down, and the guy was punching it on the machine, and $1, and it cost 73 cents with taxes, right? But he's doing 1 minus. I said, give me 27 cents. And he stared at me, and this I'm not joking. He stared at me and said, man, you must have a PhD in finance. And I'm standing there, I said, actually I do, and that was my thesis. With that I just told you. So I mean, I'm just telling you, I'm making fun of you. If you don't like numbers, try to like them. They're once you have a comfort level with multiplying and dividing, that's all we're doing. So if you don't take my jokes personally, you can have fun at my expense, and somehow I'll get to know you're doing that. So now that you know the examples and all, let me now spend time, and I'm going to take about 15 minutes to 20 minutes on this to set up what is the most interesting piece about stocks and the last major piece for our today's session. But it's extremely important that you understand this. So just hang on with me, and this is a point where if you get this, then you will be able to go back to other resources and understand. And that's the purpose of the video. The purpose of the video is to motivate you to learn by showing you the essence of what's going on, right? Why things are working. So what's the engine of growth? The first thing you must remember is that, I have said this several times, but one more time, that real assets, your business, create value, and they can be financed by either debt or equity. But equity is the one that's taking on all the risk, giving your own money for your business or to other people through markets without any promise in return. Turns out that kind of giving leads to growth, leads to value creation. A contract is not value creating. Why? Because if you tell me, show me what you'll give me back, you can't participate in the value creation. Obviously, equity will suffer from value destruction too, but that's where the risk comes in, right? Okay, anyway, so let's start off, and I'm going to introduce some terms. I will assume you agree that you need capital to start a business. Remember what I told you when we did cash flows? What happened at time 0? You had to make some investment, minus I naught, right? I will do everything per share. Why am I doing that? Because the way stocks are traded, and we'll see today, we'll go to the website right at the end. The way stocks are traded per share, right? The whole company doesn't trade. If that were the case, it would be really difficult for trading to occur. So I will call this invested capital per share. So please write this down. As I said, my videos are supposed to introduce you to ideas, and then you make your own notes. So capital per share is invested capital per share is the terminology, and you'll see this in books and so on. Okay, and this is please pay attention to this. Okay, you need invested capital per share. So I have put some money in my idea, and remember, for convenience, I'm going to use perpetuities. Why? Not because I know perpetuities give me the right answer, but just as a framework of understanding what the heck is going. And as it turns out, most long-lived ideas are approximately priced very well by perpetuities. Okay? The second idea I'll give you is, so you have done your capital investment, but in order to at least survive, what do you need to do? You need a return on investment. So let me repeat that. You made invested capital per share. You can call it return on capital. Many people call it return on investment. That needs to be some positive number. So we'll assume that's greater than 0. Why have I laid these two things out? Because turns out that if I take my invested capital per share and multiply it by my ROI, what will I get? I'll get my cash flow. That's the beauty of a perpetuity formula, that invested capital per share multiplied by ROI gives me. So we'll do an example in a second. So what does cash flow? In finance, we call it earnings per share, but I must warn you about this. When I say earnings per share, I mean cash flow per share. The reason I'm warning you is the earnings per share you see in accounting statements, as I told you when we did cash flows, accounting statements have to be used to create cash flows. Not that they're trying to cheat. Their way of recording stuff is very different from actually when the cash flow is happening. We know how to do this. The only reason I'm saying this is because in the real world, earnings per share is used, the same language is used, it may mean different things to different people. But in finance, earnings per share is cash flow per share. Okay? Is equal to ICPS times ROI. So what do we mean by engine of growth? What am I trying to explain here? One thing very simple. I'm first starting off that if you don't have any resources put in, you cannot have cash flows. That's a very simple. If you don't have assets, you cannot generate a business, right? Whatever the business may be, whatever the cash flow source may be. All I've done is I've made it per share. But I'm making a second point, which hopefully everybody recognizes, that if I don't make any money on my capital, cash flow, nobody is going to finance it, and I won't want to. And you'll see this condition is not really that strict. Okay. But what is my cash flow then? If I'm using perpetuity, cash flow becomes very simple. And we'll do problems in a second. And I again tell you right now, just think about it. So I've generated my cash flows. So this times this gives me my cash flows. Now comes the really fun part. We have our cash flows. Who generates our cash flows? Assets. Real assets. In generating these cash flows, in creating these cash flows, do you ever go to the liability side, or do you remember MC Hammer? Can't touch this. Can't touch this. Okay? So remember, the cash flows have nothing to do with the financing. So what the heck is that ROI? There's another word for it we used earlier. It's called your rate of return, internal rate of return. We are just throwing lingo now that you're comfortable with the basics. All over the place there's lingo, and many things mean the same thing, right? And many things are slightly deceptive, like earnings per share mean one thing in accounting and another to a finance person. But remember, the finance person is the cool person. We are dealing with reality and not just languages, okay? Languages are awesome, but they are not necessarily real. Okay, so I have generated my cash flow. Now here's the cool thing. At any point, you have two choices. And let us just make a simple assumption, which I think I made at the beginning, that we have no debt right now. And the reason is we are focused on valuing stocks. So if you bring in debt, it's only going to make you a little bit confused. The other good news is that a lot of companies have only stocks, and you'll see that in a second. The final thing is, if you don't have stocks, if you don't have invested capital, if people haven't put up their money for risk, nobody is going to give you money. No bank should give you money, because it will create perverse incentives. Okay? And by the way, a lot of the crisis, partly that happened. Okay? So just remember that. Okay, the first thing you could decide to do is pay out a dividend. Right? Suppose I was making $10 this year. My cash flow was $10 and I had 1 share, simple. I could give all $10 out, right? And what do I call that? Dividend. But if I paid all $10 out, how would I grow? Right? So there is a second thing I can do, is called retained earnings. Let me write it out. Retained earnings. Now you see what's going on. Very simple. I have generated some money from my previous assets. I have generated, say, $10 this year, and we'll do detailed examples. I could do two things. I could either pay it out or I'll retain it. Now, it seems like a naive person would say, give me all the $10 right away. I'm a stockholder. That's not quite the smart thing to do under some circumstances. So question is, when would you retain earnings? When would you want, you are the shareholder, you are the investor, when would you want the company you have invested in to retain part of the earnings? When it has great ideas for the future or not so good ideas for the future? When it has good ideas for the future, right? So retained earnings goes back, and that's why I said this is an engine of growth. So let me just make one thing which will make our life simple. I'm going to divide this by earnings per share and divide this by earnings per share. And these become fractions. Okay? And this fraction I'll call B, and this fraction I'll call 1 minus B. So if I add B and 1 minus B, what do I get? 1. So the fractions have a very cool thing about them. I can just multiply, it's like a factor. So of every dollar, how much is this company reinvesting? B. If it's reinvesting B, how much is it paying out? 1 minus B times the total cash flow. Does that make sense, right? So one last step. Where does this B go? This goes back, and I'm going to do a circle. It goes back to replenish your capital. But for what purpose? The purpose should be to create more capital, more assets with good ideas so that you grow. One last step and we are done with the concept. So now you understand what's happened. You had initially put some capital, invested capital per share. That capital is earning a positive rate of return. You're getting some cash flows, which is a product of the two. Suppose that cash flow is $10. You have two choices as a company. Either pay them all out of dividend or pay part as dividend and part retain. Or don't pay anything. Microsoft didn't pay any dividend for more than 2 decades plus some. Why? Because if it paid dividends, people would say, what the heck, why are you doing this? You've got such awesome ideas. Just use it. Take my shirt too. You know what I mean? So there's something called negative dividends. I was a shareholder. If I was, and I knew Microsoft could grow so fast, I would give more to them. Because dividend is a way for the company to pay me, but I may want to pay more to buy more shares, give more money. Anyway, so it's not the case that you want to think, oh, getting dividends is good or bad. It depends, right? It depends. So now suppose B is retained and it goes back and replenishes capital. What will it generate? It will generate the G we have always looked at. The G, the growth rate in our cash flows. And I'm going to write the formula here, which is very intuitive. And that's it pretty much. This is the engine of growth. Okay? So what is the growth coming from? If I do not put any money back in the company, if B is 0, growth can't happen. It can happen organically by chance. I'm talking about growth by design. Right? So for example, if iPad wasn't produced, could Apple have grown to be as big as now? Probability is low, but it could have happened. Suddenly some accident happened to every other company producing phones and Apple just took off. I'm not talking about that kind of growth. I'm talking about sustained, thought out, planned growth. So you have to put B has to be positive. But suppose I put B back and my ROI is 0 on that B, additional B. Will I grow? No. So it's very intuitive. I'm not going to derive it. I have now shown you the engine of growth. So when you use the formula of a company with growth, what are the things you use? First, dividend over R, you already know those two, minus G, and this is how G is calculated. So I think a stock reflects the engine of growth. What I'm going to do now is I'm going to take a break. But I will let this slide stay and stare you in the face so that you have the time, 5 minutes or so, to just stare at it, look at it, derive it for yourself, think about it. And then later, I would even encourage some of you to go to a book and see how they'll do it in a very detailed fashion for you. Okay? You have the ability to take care of resources outside of this video. But I want this video to be the process through which you get the essence of what's going on and just leave the details a little bit out. Okay? So I'm going to take a break now and come back and wrap up what we did with examples and show you something quite startling. See you soon. Welcome back, and now for some exciting stuff, just to show you why markets are important and why what we do in finance is all there. Every time I leave you with some thoughts that have nothing to do with the class, and I want to leave you with one thought. Markets are more powerful the more people are able to participate. Markets are not very powerful. They do not create value if people are left out of them. It's just like democracy. And so please keep that at the back of your mind, that a lot of us do not have even the opportunity to participate. But I want to show you how markets work and how they are just the same thing that we have been talking about. I'm going to try to prevent myself from going too long, simply because, this stuff is, we could go on this forever. But I'd encourage you. If you notice, what I have up there is the good old Yahoo Finance. It's finance.yahoo.com, and I'm going to launch it from here. And if you notice, it jumps straight, and I would just quickly browse the top part. If you look across, what is it showing? It's showing Dow Jones, which is the top 30 companies. S&P 500, we spoke about it, I think, a little bit. It's a large portfolio. NASDAQ is another exchange. But notice what's here. 10-year bond. And if it says 10-year bond unqualified, what do you think it's talking about? The government bond. And what is the chances that this bond will be paying a coupon? Pretty high. And the reason is very simple. Coupon paying bonds are much more common than zero coupon bonds. Just for some fun, there's an exchange rate here between the euro and US dollar and the price of gold. Gold fascinates people. It doesn't fascinate me very much because I don't know why its price behaves the way it does, to be honest with you. Okay, what I'm going to do is if you're coming with me, I'm going on the right panel of the site, right for me. And you'll notice there are some currencies. And this class doesn't talk about international finance, but I think that's a topic that is extremely important. And what's listed here are different exchange rates. And at some point, after this fundamental class, if I do get involved in continuing to do online, I want to do international finance. I want to do valuation with a lot of real world examples, cases, and so on. But I'll talk about that on the last day of class as to how do we go beyond. But just let's scroll down a little bit. There are commodities, which is not in the class, but they are bonds. Now notice right away, you see a 5-year, 10-year, and 30. What do you notice? In the 5-year, 10-year, and 30, the one thing has to be the case. Unless qualified otherwise, it has to be a government bond. So I'm going to now click on more bonds. And if you see, there's a whole table here. And what do you notice? You notice a 3-month bond, treasury, and the word treasury means government, 6-month bond, a 2-year bond, a 3-year bond, a 5-year bond, a 10-year bond, and a 30-year. These are not the only ones, but these are the listed ones. And what is happening to the yield to maturity? It's showing yield to maturity right now, and it's showing yesterday, last week, and so on. So let's stick with the yield right now. It's 0.05 for a 3-month, 0.12 for a 6-month, 0.26 for a 2-year. And by the way, they are all annualized so that you can compare them, right? Otherwise, obviously, a shorter interval will have a lower rate of return, right? But what you notice, even annualized, what's happening? It's almost remarkable, the steady increase in them. Can you see that? Yeah? And what is that over here? Let's go to the right side. The right side has a little graph, and this jumps out at you in whatever country you're in. This is the relationship between the interest rate or yield to maturity built into bond pricing with maturity. So let me just click on it and it will jump out. So this, if you look at this graph, it is showing you how steadily the interest rates and the yield to maturity on a bond is positively related to the horizon. And this tendency, if you dig deeper, this is a tendency, this is not a fact. This tendency all the time pushing upwards is because of 2 reasons. Long-term bonds are much more volatile than short-term bonds. Compounding. And we do not like that movement. Are you with me? We do not like that movement. So if we don't like the movement, what are we willing to pay? More or less for that bond? We are willing to pay less. And if you are willing to pay less, what does it say about the yield to maturity? Has to be higher. So remember the one thing, yield to maturity goes up, price goes down. The whole thing. So what I'm going to do spend a little bit more time on this just because we are talking about bonds. And when we do stocks next week, I'll come back. But bonds problems are very interesting. So this table we just saw. And look, what are these? US Treasury. Now look, rated municipal. Why are they rated? Because these are issued by municipal governments, local governments, and bonds. And they too are rated because the probability of default is there, built in. Now the question here is, the maturity is increasing and the tendency of the interest rates to increase with maturity is there, right? But what you also notice is something which should be pretty obvious, is that the municipal bonds in the US are taxable, tax exempt, whereas treasuries are taxable. So what you'll notice is everything else the same, that tax thing should come through. But we are not talking, I'm not interested in municipal. I'm much more interested in showing you something which is peculiar to the US largely. Corporate bonds. And this has been a subject of a lot of pain and a lot of anxiety continuing to be the case. And the reason is there has been a lot of turmoil in the financial markets. So if you notice what's going on is you have ratings, right? So which is the highest rating? AAA. So if you look at all these bonds, what you'll notice is there is a positive relationship. The higher the rating, the more you're willing to pay. And therefore, the return you're willing to get is lower, right? So look at these last three bonds. As the rating goes down, the yield to maturity goes up. And the reason is very simple. The yield to maturity is fixed for all three, right? And why is the maturity is fixed. Why is the yield to maturity going up? Because in order to entice you to buy a low rated bond, and given that you are risk averse and I am risk averse, we are willing to pay less, which means automatically we want a higher return. I told you I'll start talking about risk and return. So this is the relationship between the two typically. One last point, and do it on your own. Go to Yahoo Finance page and do the following, answer the following question for me. Which bond will pay a higher rate of return? A corporate bond or the government bond? As long as I fix what? To be fair, I make them identical in every other respect. So at least make the maturity the same. And you should know the answer. And next time, what we'll do is we'll review very quickly what we did in bond pricing, and we'll start on stocks. And stocks are the most fascinating thing created by humanity. And I want you to also recognize, I will take the opportunity to show you value creation and destruction using stocks. I cannot do that too much with bonds because bonds are boring. You buy bonds only if you know what they're going to pay in the future. And I believe unless we all take risks, we are not going to be able to do good stuff. So risk taking is inherent to value creation. You don't want to take too much risk, but you have to take some risk. So I'll come back to this. I want to remind you, however, please go to the problem sets and assignments. I have built-in assessments here. When I do a problem, I ask you to do it and then do it with you. So I'm not too worried about the video assessments because I think everything I do is with an example and you do it with me or on your own time. What I'm really want to test you on assessments is in your assignments. So please do the assignments. Please redo all the problems. Make sure you got them. You can go back to the video. Take the problem, do it, go back to the video and see if you got it right. See you next time. Have fun. Hi. To wrap up this week, I want to again spend a few minutes on the website that we were on. And by the way, finance.yahoo.com has a lot of information. Google provides this information. But if you want to do more precise, thoughtful stuff, Morningstar is a website, morningstar.com. And there a colleague of mine from Chicago has developed ways of measuring things and so on, which are very refined, because remember, it's measurement is statistical. And I'll give you those resources. They are there in the course website, but I just wanted you to know that there are multiple places you can go. Okay, so let's go to this website we saw. And the reason I'm going there is simply to show you again how cool finance is. So we talked about something. We talked about stocks this time. So remember last time I told you on top, what are they showing? Now look at the first item. It's S&P 500, right? And NASDAQ. I think most of you should be able to kind of Google what this means. S&P 500 is a collection of 500 stocks. So it's no different from what we did, except it's a portfolio. And that sets us up very well for risk and return. And you'll hear the word portfolio coming up over and over again. And I'm very excited about talking about this. In fact, all my research that I have done over the years is on stocks, largely. NASDAQ is another index of stocks exchange where stocks trade, and there are a bunch of them. The trading mechanisms are slightly different from New York Stock Exchange and so on and so forth. Okay? And it says over here, after May swoon, be wary of buying into a June bounce. I don't know what the heck that's supposed to mean, because stories like this just blow my mind. It's almost like the person writing it seems to know what's going on. Nobody does. Let me assure you, and finance theory says you shouldn't be able to know what's going on in the future. That's called, essentially is the basis of market efficiency and random walk. The notion is this: if S&P 500 is 1311 today, it's big for a reason. It's based on what we all collectively know today. So how could we know anything different than the 1310? If we did, it would be in the price. That's the notion. And whatever happens in the future is mostly because of stuff we don't know, because it hasn't happened. Of course we make mistakes, but that's not what I'm talking about. Mistakes happen, period. I'm talking about patterns. Okay, if you go down, then you'll start seeing the exchange rate on the right and stuff like that, commodities, bonds we spoke about. Okay? And so you can pretty much cover the whole news. And here you'll see the most active stocks out there, right? So I don't want to necessarily focus on them, but we saw portfolios. Now you have price of stocks, right? But let's see, what company were we trying to evaluate the strategy of? Remember, it was called Macrosoft. So let me just assume that it has something to do with another company with soft in its name. So if you want to evaluate Macrosoft fundamentally, where do we have to go to figure out the 12% rate of return? Let's assume that Microsoft is a company I would pick just because I thought of the word soft in both of them. What do you have here? You have the price of Microsoft is $29 or so. You have previous prices, your prices at open, close, your bid and ask. Bid and ask are slightly different because the person trading has to make some money for the kids, right? So they buy they're always ready to buy and sell. Just to show you some numbers, and then we'll take this break. We'll come back to this again. Is 245.14 billion is the market cap. What does that mean? Market cap means price times number of shares. And that's the total market value of Microsoft as we speak. $245 billion. A lot of money, right? This earnings per share is not the earnings per share I was talking about. I was talking about cash flows per share. This is accounting versus cash flows, remember? Okay, one last thing I wanted to show you was, and we'll do this next time when we go into risk and return and evaluating, is there's a key statistics thing, a little link here, where a bunch of stuff is reported in addition to what we just saw. And what I'm going to go is I'm going to scroll down very gradually and give you some sense of numbers we will do. Look, even cash flows are calculated for you. But I would do these on just confirm what the definitions are, how they're doing it, and so on. I just wanted to show you one number. Look at the debt. Do you see that 13 billion? Now look at the market cap, 245. Right? Enterprise value and is lower than the market cap because the difference is just cash sitting there. It's called excess cash sitting there, right? So the value of the company says 245. Let's include the cash. And how much debt? 13. So what is the assumption we made in our valuation till now? Let's just have only equity. No. Do you deny that's almost true? It's almost 100% true. Many companies have no debt, so it's not an imaginary thing. But you won't find companies with no equity, because if you do, that company would have taken the bank for a ride, because you have every incentive to take risks, because you can walk away if you lose everything, but you get all the gain. That's the tragedy of a debt contract. See you next time. Browse this website, but most importantly, I encourage you to do the assessments, assignments. If you stay on top of that, you will not need to relearn finance. Take the time on a weekly basis, and I'm forcing the class to go 1 week at a time exactly because of this. In fact, if you get tired of listening to me, just take a break and do some problems. They are organized in an increasing difficulty level, and doing problems, assessments, not just those in the video, but is the only way to learn finance. See you next week and have a good time.